Thank you to everyone joining us. We're just going to give it a minute or so for everyone to start filtering in, and then we'll kick off the webinar. Thank you to everyone filtering in. I just mentioned we're just going to give it a couple of seconds while everyone filters in, and then we will kick it off. I think we're ready to go.
A very good evening. My name is Vinita Matthew, and I'm the Director of Programs at Pearl Initiative. I'll start off with so very warm welcome, and thank you so much for joining us this evening. Today's session really focuses on fintechs in the Saudi Arabia, but really with a focus on how do we build fintechs for the region from the region, looking at good governance as a key driver for the performance and growth of the fintechs. Before I talk a little bit about the session, I would like to give a small introduction on the Pearl Initiative and what we do at Pearl Initiative. So Pearl Initiative is a Gulf-based NGO, and our focus is on corporate governance. So we look at promoting transparency and accountability for businesses within the region. We work within the Gulf region. And we do this through a lot of convenings, which includes trainings and workshops, but we also do a lot of research-based work, which includes creating tools, contents, research guides, basically to share information on the importance of good governance, but also how do we use corporate governance as a key driver for growth within organizations, but also as a sustainable tool to manage growth and to manage the organization for the long term. At Pearl Initiative, we have several programs. This includes 6 key programs that we run, which focuses, our programs focus on corruption, some of them on diversity and inclusion. We also have a program around philanthropy, but the aim of all these particular programs is the base is corporate governance, and how do we use these to drive different operations and different processes within the organization in a transparent and accountable manner. Please feel free to go to our websites, check out our social media handles, please start following them. I will also now show a small video just to kind of give you a full glimpse of what we do at Pearl Initiative.
Connecting leaders from across all sectors to address these very challenges, we aim to collectively design self-renewing models of collaborative governance that will ensure the vitality of the region's economies and societies for generations to come.
The youth are the future workforce. They are the future leaders for the businesses that fuel the growth of the region.
It is a privilege to be working with the Pearl Initiative in promoting higher governance standards, something for which there is a clear regional need for.
For our businesses, for our community, the more we engage the youth, the students at universities, the youth in their businesses, entrepreneurs, that is the area I think we should focus going forward.
You know, the Pearl Initiative started at a time where there was very little information about governance and very little even direction towards governance. And in the past 10 years, this has changed. The momentum is growing daily. And I would just say we need to continue what we're doing. We need to increase the way we are showing how transparency can be beneficial.
Thank you so much. Just to give a quick glimpse into the session that we're running today. So this session is part of our governance in the tech program. And this session is being run in partnership with the Islamic Corporation for the Development of the Private Sector. So with the ICD, we have planned a series of 4 sessions, out of which we've already run 2 in the UAE previously. And these are the remaining 2 sessions that we are doing. And these sessions really focus on the importance of corporate governance for the fintech sector, for the growth of the fintech sector, and how do we actually incorporate governance into these sectors, and for them to understand how this can actually aid growth rather than deter growth. So these series, which we've been running, are a part of many of the different sessions which we're running within the tech sector, with the focus on raising awareness on the importance of governance and why startups and organizations with the tech sector should really focus on governance within their growth mechanisms. The session today focuses on the importance of building a strong fintech sector for the region from the region while focusing on the local context. Saudi Arabia in recent times has been rapidly growing its fintech sector with almost like 155 registered fintechs at the moment. And the Vision 2030 and the Saudi Arabia fintech strategy have a huge ambition to increase the number of fintech sectors, fintech companies to about 525 by 2030. Which is a huge growth plan and it's a big ambition. But this also means that the importance of good governance and compliance frameworks to match this ambition and to make sure that we're reaching that growth becomes very, very critical. So thank you once again to ICD. And I would also like to welcome our esteemed speakers, Mohamed AlTajer and Noel. Thank you so much. And I'll now hand it over to Mohamed to take you through to introduce our speakers and also take you through the brief of the session.
Thank you, Vinita, and a good afternoon and good evening to everyone joining us. My name is Mohamed AlMusa, and I'm the program manager for the Governance in Tech program, as well as the Governance in Family Firms program here at the Pearl Initiative. As Vinita mentioned, this is a webinar as a part of a series of fintech events being run by the Pearl Initiative in the UAE and KSA, and is supported by the Islamic Corporation for the Development of the Private Sector, and we thank them for this support. I would also like to thank our esteemed panelists today, Noel and Mohamed, for being with us here today. We appreciate your time. And of course, thank you to all of you tuning in. We have quite an insightful panel lined up for you. So first off, let me start by introducing our panelists. Noel Connolly is the CEO of Now Money, a Dubai-based fintech which aims to provide financial literacy and inclusion across the United Arab Emirates and the Kingdom of Saudi Arabia. Noel has over 25 years of experience in business and tech with proven skills in driving scalability. He has a wealth of UAE-based and international contacts in banking, government, and fintech. His previous experience includes SVP and Global Head of Sales and Partnerships at Cellpoint Digital, an up-and-coming payment orchestration provider, as well as commercial roles with Sabre Group Corp and Emirates Group. Noel joined Now Money to drive change and build awareness for financial inclusion, which is at the heart of Now Money's mission. I'd also like to welcome Mohamed AlTajer, who is the founder and managing partner at Taghyeer Consulting. He works at the intersection of business, technology, and marketing to help organizations transform and grow. He worked in Europe and the Middle East and led teams in over 40 countries across Europe, the Middle East, Asia, and Africa, including Fortune 500 companies. These include Citigroup, the National Bank of Kuwait, Unilever, and Wrigley, among others. His experience spans other sectors, including FMCGs, airlines, and retail. Mohamed is a fellow of the Chartered Institute of Marketing in the United Kingdom, one of 3,000 fellows globally. He advised in the areas of strategy, marketing, transformation, growth hacking, turnaround, customer experience, and the use of big data. He's passionate about startups and associated with accelerators like Brink and the DIFC's Fintech Hive. Before I revert to our esteemed panelists, let's set the scene. As Vinita mentioned, it's no secret in a global economy of uncertainty and instability, the GCC is, well, doing quite well, to say the least. And the Kingdom of Saudi Arabia has experienced tremendous growth and transformational change. In a country of over 35 million people with a GDP per capita of $23,000 and internet penetration of 93%, these figures we see across the region as well, it's only logical to see a significant amount of investment poured into emerging technologies. I don't want to focus exclusively on the funding side of things, but it's important for the context, for the environment and the boom we're seeing in tech in both KSA and the region. So in 2022 alone, there were 144 deals accounting for over $987 million in funding, which is up from $575 million in 2021. This is according to Magnet. And at the forefront of this change is financial technologies, which saw over 25 deals and around $400 million in funding in 2022, according to Fintech Global. As Vinita mentioned, there's over 100 Fintech startups in Saudi today, 60 of which have been licensed by SAMA, the central bank. And there's some very lofty targets by Fintech Saudi, which they are aiming to reach by 2030, which is around 525 players by 2030. Like we mentioned, there's just over 100 today. They would like to have 18,000 employees serving in the industry. They're currently just under 4,000, which is up from 1,000 in 2020, according to an Endeavor Impact 46 report. And they're looking to have a GDP contribution of over 13 billion Saudi riyals. So according to the same Endeavor Impact 46 report of the fintechs surveyed, the majority are targeting underbanked SMEs as well as corporates. Our panel here today is to discuss why it is important to build fintechs that are for this region, from this region. On that vein, Noel, I'm going to start with you. And I know I've thrown around a whole load of numbers, but I promise I only have two more. Of the fintechs surveyed in that same report, which was done by Endeavor and Impact 46, only 8% of those fintechs surveyed are targeting underbanked consumers, and only 6% are targeting the unbanked. Was that a factor in Now Money's expansion to Saudi, and frankly, why it was founded and operating in this region in the first place? And how have you approached your entry into that market?
Yeah, firstly, good afternoon, good evening to all, and thank you to the Pearl Initiative and your partners for inviting me to speak today. Yeah, as you mentioned, Now Money is what you would call a social impact financial inclusion fintech, or TechFin, as we probably would prefer to be known as. And we were primarily set up because we understood that there was a large section of the population in three categories of underbanked, unbanked, and underserved, who weren't being fulfilled in the continued digitization of banks and the general ecosystem in the Middle East. So we worked with a lot of the labor camps, the initiatives, Bill and Melinda Gates initiative, and a lot of the corporates to understand the behaviors of what's missing. And from a lot of time spent with the workers in this segment, it seemed like being able to have access to their funds and being able to use them at their discretion and keep in contact with their families back home, with the financial obligations they have from working, was the biggest challenge. So obviously we started in the UAE because we found a partner bank that they had quite a number of these that they wanted us to migrate across. But then as we started to grow into the region and sort of any fintech, they kind of test as they go, or A/B test on the fly. And we found that financial inclusion in general, which is the three segments I mentioned, this region, and primarily the UAE and Saudi Arabia, have the largest population of these migrant workers, and particularly those who need to send their funds back to their families back in subcontinent, in India, Pakistan, Bangladesh, Philippines, Nepal, etc. So I think last year there's $41 billion worth of remittances sent from Saudi Arabia directly to that market. So obviously we had built our traction, and we really wanted to make sure that we produced a product and a service that added value to these users. And then really it's a case of where it fits to expand beyond that. There's 525 million people in MENA, of which probably 25% of them are in this segment. Countries like Egypt, and if you include places like Pakistan, there's a huge lack of actual banking and digital banking opportunities. But if we look at where our core value add is to users, to help them remit and provide other services to their families back home, the two largest markets are the UAE and Saudi. And what really made our main reason for moving into Saudi Arabia was government initiatives that tie alongside some of the international initiatives. So the UN has a 2030 plan. Obviously in the UAE, we've got COP28 this year, and then Saudi has its 2030 development plan. And within that, there's strategic tenets of it, reducing inequalities, more inclusion, better living and working conditions. So it was only natural for us that Saudi Arabia was a market that we needed to get involved in. But obviously, because it is so big and spread out, there's much more complexities in terms of availability for them to send funds home and have access to services that would probably be easy to do in places like the UAE. So we thought to really add value, we've got to get in there early and work with the right initiatives and the right partners. So, that's kind of the main reasons why we looked at Saudi Arabia. There's probably 4.5 million in the UAE in this segment, but in Saudi, it's more like 15 to 16 million. So there's a huge addressable market. And our mandate as a company, as well as growing a fintech, is to make measurable change in financial inclusion. And we feel that if we are going to be leading other companies to try and make that change for the better, that Saudi Arabia is very important on that, and it's very important we get in there early.
After 3 years, you'd think we wouldn't have this I'm on mute problem, but here we are. Mohamed, you've been on both sides of the coin. You've had extensive experience banking here in the GCC, and now you work very closely with fintechs. I think a lot of the fintech founders that are listening here today want to understand how can they bridge that gap. As Noel was saying, there's these underserved or unserved markets or communities in this region. And there's a huge level of potential, both from a funding perspective, but also from a market perspective. How do potential founders, early stage founders or potential founders bridge that gap and potentially partner with these banks?
Well, thank you very much, Mohamed, and good evening, everyone. And thanks for the Pearl Initiative and basically the other sponsors of this session today. The fintechs I think the surge in the number of fintechs coming in basically the funding rounds and the valuations that we have heard. But just keep aside what happened recently in terms of the tech industry taking a little bit of a hit, but there is a lot of gaps, and it's not only in the financial services and banking that I'm talking about. In general, big companies, established players in any industry you take, they always focus on the biggest market, segment. So they want to serve the largest number of people who basically fit certain criteria and allow any organization, banks included, to make basically decent revenue and decent profits. Of course, having said that, there will be certain segments, in this case, the unbanked or the underserved, that will not be feasible for banks historically to address. And if you see most of the disruptors, whether fintechs or any other basically industry you take, basically they are focusing on the niches that are not addressed by these big companies, banks included. So basically, there are a lot of pain points. Noel mentioned, basically touched upon it, and I'm sure he will touch upon it later, is that a lot of unmet needs for these neglected, quote unquote, niches or segments. And with the advancement in technology that happens over the last 5 to 10 years, it enabled a lot of new entrants to the market, where basically they leverage technology to address a pain point such as remittances, payments, you name it, opening a bank account. And so and also, having said that, there is two things actually that helped this for tech or fintech companies to take a center stage role in this. The advancement on smartphone. Now, basically, you can use this as your laptop, and the other thing, the speed of which information now is being traveled with 5G. Basically, most of the countries in the Gulf have rolled it out. This made things easier, with the relaxation also of the policies and regulations by the central banks or the regulating bodies in the GCC and other. So it made it very easy for basically, relatively easy for fintechs to come in. Now, initially, if you remember, maybe 5-7 years ago, a lot of fintechs were basically coming to the market, and they want to take basically the banks by storm, saying, you know what, we will take your business and we will disrupt. We have excellent CX or customer experience solutions, easy to onboard, no questions asked, low fees, blah, blah, blah. Banks were scared, of course, for the business, and they were on the defensive side. Now, we've seen that this did not work in many cases, but in some cases it worked. Some of the basically fintechs went ahead and been very successful, but I think the majority found out that we need a banking partner. Because they have something that we don't have. I'll give you an example. Banks are good in compliance and governance and controls, and understanding basically and working with the regulators. Fintechs normally, some of the founders have not been exposed or have not worked in the financial services industry, so they lack that experience. Even how to deal with a regulator is also, and what if they need to be regulated and by who, and when it comes to things like money laundering and cybersecurity and the likes of such areas that any financial institution, whether it's a fintech or a bank, has to take care of, they lack. So we reach to the new equilibrium state, where a lot of basically fintechs are putting hands together with banks, and they recognize that we have to coexist together. Since we have to live together, why don't we put hands and join hands and work this together? And banks came to the conclusion that yes, you know what, in some cases we are not agile. We don't understand how to give basically the right products at the right speed for the unbanked or the unserved, or even the youth or Gen Zs. There are good examples coming, and Noel just mentioned that he is partnering with the bank because he needs them and they need him. So I think overall we will reach to a stage where I think there will be more collaboration between both basically entities, banks and fintechs. And I think the main thing is basically to tackle a pain point, whether from a bank perspective or a fintech perspective. The real enemy is the pain point. It's not, each other.
We reached the very sticky subject of regulation very fast, and it was asked in the chat as well. So, and I encourage all of our attendees, if you have any questions, to put it into the chat, and we'll get to it at some point. But because you did bring up regulation, I do want to talk about it, because every time we have this conversation around fintech in the region, and our last discussion was actually titled "The Elephant in the Room: Fintech Regulation in the GCC." This subject comes up. And as you mentioned, in banks, you have very large departments that are, in charge of compliance, in charge of risk, in charge of governance. And in fintechs, you don't really have, the time or the resources to focus on these things. Noel, as Mohamed mentioned, you're partnering with a bank. How do you deal with that? And what kind of advice would you give for other founders building in this region around dealing with regulations and having that conversation with the regulator? I mean, we have to innovate, but we do need to protect consumers as well.
Yeah, it's a very interesting point, and I think it's one that gets confused by people understanding their own interpretations and either thinking it's bigger than it is or ignoring it altogether. From my side, I have an in-house compliance and audit person that her role is a twofold. Is one, to make sure that we work effectively in line with our partner bank, because they help us with their license. So therefore, when they get audited by the central bank, we need to make sure that we are audited to the same standards. And then the second thing is looking at what within the license and regulations, what's actually necessary. So if I look at the UAE as an example, and I'll go on to Saudi after, in the UAE, up until 2020, 2021, there wasn't really a framework for actual licenses in the environment of quite a lot of fintechs, which are like storing wallets like ourselves or remittances. So they created what's known as stored value facilities, an SVF license or an RPS license. So this SVF is a much more stringent license, requires a lot more elements to it and capital allocations, etc. And the RPS is kind of the lighter version of it. Now, if you were a fintech prior to that, you were still fulfilling all of the regulations that the central bank had wanted, but you just weren't doing it in the framework of an actual license. So most of these licenses come from like Singapore or Hong Kong or places in Europe where they've had framework for the longest time. So it's understanding the interpretations within it. So for us, it's a case of looking at how and what do we need to comply with, and also working with both the regulator as well as the central bank to say, because the central bank is not just a regulator, the central bank also has a compliance department. They also have a fintech department, is to try and understand the interpretations of it. So if I'm a bank and I have the RPS license, I need to do a various number of things. But if I don't do all of those services as a bank, including lending and various other things which require capital, I don't need to do the same things. So it's important to work and understand what it means for you. So governance that is enough to have the right standard operating procedures and elements that the government's going to want to judge you on. I think Mohamed already mentioned things like anti-money laundering and KYB, know your business. In terms of the value of monies being sent and understanding where that monies have come from and the source of funds. I think a lot of those frameworks should be in any fintech anyway. The question is in terms of where they are in the value chain. And then if you go into Saudi Arabia, SAMA is slightly different approach in terms of they actually licensed based on the services that you provide. So when we go into Saudi Arabia, we'll be doing remittances and mobile top-ups. If we want to add some of the other services from the UAE, we have to get a specific, go back to SAMA and get another update. So it's a little bit of a different approach, but it's much easier to understand and be regulated against the services that you provide. It might be the longer path, but it'll make a little bit more sense. So you got to remember that the regulators and the central banks are trying to have a blend of encouraging entrepreneurs and companies to set up, but at the same time putting in global standards for regulations and compliance. So on one side, there's a big influx of companies coming in, but on the other side, somebody has to police the police, as they say. So as a founder or as a company, I always say, firstly, understand your customer, what your customer needs. Secondly, understand what that means in terms of products or services. And should it require a license now or in the future? Like our decision was, should we partner with a bank that can facilitate part of that while we grow our traction? Or do we want to take all of those things on our own back and do it ourselves? Because you need to build in the need for time. And anybody who's tried to get licenses here in the region, the first thing they want to know is your business plan and what your company does and what you give back and how you're helping with their strategic tenants. The second is, have you got traction and things like that? So quite often the route to doing it is to partner to start off with, prove your capability, so then you can make it easier to do that transfer. But in summary, your governance and compliance of how you do it is important, that you kind of audit yourselves where necessary, but it's working in line with what the regulators want, but also having some experience, as Mohamed mentioned, of people going through it to see what you absolutely have to comply to. Because if you just look at the letter of the law, you'll find out that there's so many complexities in it that you may over restrict yourself or under restrict yourself. So you need to both look at the legalities of it, but also the practicalities as an agile business, and always work with the regulators and industry bodies to try and understand if the use cases are what they are intentioned to be. Because quite often the use cases are intended for banks and other organizations, and therefore not all of the use cases apply in the licenses, if that answers your question.
I think that was a fantastic answer to my question. And actually, you brought something up, which one of the panelists in our previous discussions said, which was, and I love this, and I keep repeating it. He said that your governance can be your growth hack in fintech in this region, and who's on your board of governors can be, your key to unlocking regulation. Mohamed, you are a board member for a fintech in this region. How do you, as a board member, you have an even stronger fiduciary duty to ensure that the organization that you are governing is compliant with, what the regulator wants and is ensuring that, customers are kept safe. How do you approach regulation as a board member when you're dealing with a fintech that tackles multiple markets, and how does the board look at that?
Well, actually, a very interesting question. The thing is that most of the founders of fintechs are young, younger than me, of course, and I look at Noel now. And they are basically having this drive and to move things fast, because they don't have time, impatient, they want to do things yesterday, and I love that. When it comes to basically the banks and basically the regulators, it's like, we all remember the first time we were put in a car to get our driving license. So in the car, you have two pedals, or three. Used to be three, now two. You have the gas or the accelerator and the brakes. So you need both. To run any organization, you need the speed, agility, but also you need to make sure that you have the other basically foot, or the same foot could also use the brake sometime. Thus, we, as board members, we are required actually, and it's part of our obligation to any organization, is to make sure that all the basically I's and dots are ticked. And so I was, for instance, in the company that I'm, in the fintech that I'm basically a board member at, I was the first board member one. So, but I made sure that I bring in a CPA, finance, ex-finance investment bank, basically board member with me. I also brought in a couple of people from, they were working with the ex-regulators or extra regulators, and also a legal person. We want to make sure that we do things right. And this was way before, and I think there is another elephant in the room. Let's talk about FTX and what happened, the crypto, and a lot of people lost money, unfortunately, and that's unfortunate. And the same people basically who bought these virtual cryptocurrencies came to ask who is regulating such businesses. And it begs a big question. I mean, in the region now, we've got very basically high activity in terms of coming up with some regulation for cryptos, and basically businesses that in that space. And we have actually homegrown businesses in crypto, whether exchanges, without mentioning the names, that are from the region to the region. However, having said that, you still need basically somebody who will give you the oversight and basically lights the torches around you so that you see what's basically you cannot see. Our responsibility as board members, make sure that we tell you about the risks and the options. And we ask you basically which path as co-founder CEOs you're going to take, because every path you take or option you take will have pros and cons. So our role is to minimize the risk first and foremost. Of course, one of our responsibilities is to grow the business, but we want to make sure that you still have that one foot on the brake if you need to.
So moving from regulation, which is one sort of challenge in every region, especially if you're in a regulated activity, to operational challenges. Noel, the customer segment that you focus on has historically been underserved or unbanked by traditional financial institutions. Part of that is let's say a margin issue, but another part of that is also an operational challenge. How do you overcome these challenges, and why have we seen many more businesses such as yourself focus on this when let's say the technology started to come in that's allowed this to thrive, let's say?
Yeah, it's an interesting one. I think Mohamed touched on it a lot already, but in a regulated existing environment, trying to retrofit what you do to other environments never works. We started at a problem, and the problem being is these people were underbanked, underserved, or didn't have access to financial tools that many of the rest of us would have been used to. So when you do that, you then need to build products, solutions, and an operation to fit that. So the reason that other companies haven't been successful to do it, and the reason it's requires very lean unit economics, and it's not necessarily transferable for a large of the financial institutions, is because the requirements for these subset of the economy and just broadly as a population is different than what you would call financial services. So traditionally, financial services, from SME lending through to personal lending, investments, saving, etc., that is kind of the next evolution. I remember when I grew up in Ireland, I used to have to get my mother to co-sign if I wanted to get an overdraft, or if I am old enough, Mohammed, I had to walk into a bank and write my account down so they could tell me what my balance is. So it's just the same 30 years forward, that the services that we no longer feel are important are the ones that they're getting for the first time. So you need to build an operation which fits to that. So we work with them in the camps, made sure that everything is in like 11 languages so that they're familiar in what they're doing. Trust is one of the biggest issues. So if they operate, you need to be able to be speaking to them and letting them understand what they need to do. So we produce our own cards, we distribute our own cards and onboard them into the corporates and into the labor camps. These same team also do financial awareness training, things like watching out for fraud, how to remit back home, and they're in all of the same languages because they're from the same part of the world. We also have a contact center, which is sort of 16 hours a day, which is able to fulfill the same thing. So from an operational point of view, we're listening to the voice of the customer, and we're understanding their pain points and are able to adapt that into the products and services. And then what we've got to do from a commercial point of view is minimize how much of that we pass on to the end user, because otherwise it's not going to fulfill what we want as a company, but it's not going to fulfill what they want. I'm sure many people have seen a laborer or somebody from a camp who's queued up in a mall to try and remit back home. They will walk around 3, 4, 5 different exchange houses to send money home. They don't understand currencies, but they know that one number higher is better than the number lower. So part of it is the education and trust that they can actually do that even cheaper within the app, and why they need to send all their money home and stuff like that. So the whole operation needs to go back to what the problem statement is. And if you start up as a fintech company that we see a lot at the minute, everybody wants to get into remittances, or everybody's trying to get into early wage access. You're just trying to look at something which is common in the market, but you're not building it for those people. And that's why things like the super apps or the telco apps that have remittances are not successful, because firstly, they're not able to take the salaries in, and secondly, they're built from people that don't understand the demographic. So operationally, you have to be so in tune with what the people want and how they want it. And then you have to consistently listen to them, build a UI UX so it makes it simple for them. And don't think about what's good for you, think about how it works for them and operate around that. And then keep the economics as lean as possible so that these people have an opportunity to make some change in their life. And then as that happens, you'll build the trust. And that means it's a big awareness campaign. So it's less about fancy technology, although we have a beautiful UI UX and a great app, but more about how you actually make the people understand how it works and how it operates. So that would be my learning, and something I would always pass on to people, that don't think about something which you see as a problem for yourself. You have to empathize with the problem from their point of view and see what's important for them, because it's not always the same thing.
So a big part of what you're doing, I would say, is educating the consumer. And this ties in very nicely to one of the questions that we have from the audience. And this can go for either of you, and it kind of links also to the conversation you were having earlier. So one of our participants in the audience asked, can we say that most of the clients using fintech are educated and young people? Or is it easy for the older clients and less educated ones to be included? So this is a question for either of you. Who is it? Is it young people? Is it is it those with the graying hair?
I think it's cross between both. I have not as much gray hairs as you can see because the light is good. But I think it's the ones that are successful have a mix of both. Where new generations have better ideation, more energy, and can see problems. Unfortunately, Mohammed and myself and many others who've been around it, you have to learn from your mistakes. You have to understand what hasn't happened. I worked helping to run another fintech that was in mobile payments in the travel segment. And we kept thinking that there was going to be a big change and people would naturally start using mobile payments. But it didn't come until COVID came. That was like the big push away from cash into digital. So unless you've been in around multiple industries, you don't know what you don't know, and sometimes it's older people like myself and younger people like my colleague Mohamed. We have seen things happen, and you go with the right fundamentals and you do things the right way, you have more chance of surviving. But also because we've been scarred by mistakes and how things have gone the wrong way, we're perhaps a little bit more cautious. So I think a lot of the ideation tends to come from the younger ones, but when you start to look at things like raising capital, having a board and governance, and going to regulations, there's nothing you can do but have some experience in there. So I think it's a blended mix is the optimum. I think I've got one person within about 5 years of me in my company. The average age is probably sub 30. So, it's great for the energy and the building of it because they understand how things work. But in terms of actually the running of a company, which is often overlooked, the younger they are, the more likely they're going to be a moth to the flame on raising capital when they don't need, or raising capital from the wrong sources.
So sticking to the subject of raising capital, we're seeing, some incredible activity across the region and in Saudi. We're now seeing cross-border activity. Where a couple of days ago we saw that Saudi-based fintech Hala acquired a UAE-based fintech payment, which was previously called Point Checkout. So you're seeing a lot of activity. One of the questions in the chat was about sort of the direction of this activity. It's saying that the question is that, are we expecting such a shift evolve forward given current lack of private equity venture capitalist ecosystem? And I'll just touch on that really quickly as an answer from myself before I leave it to the panelists. Mohamed, maybe you can elaborate. We're seeing a lot of venture capital being flown into the market, right? A lot of that is coming from the government, because the question does ask us the government. A lot of the LPs, so the funders of those funds, are the government. Therefore, there is certain direction given to the venture capitalists on where to invest. But the question is asking how you see that investment landscape change over the coming years. And I guess to kind of drill down into that, how do you see that being addressed in fintech, Mohamed?
Look, I think, all governments, if we take the GCC, have got their visions and plans, Saudi Vision 2030, Oman 2040, and the rest of the Gulf have similar plans. And it's not a secret when all governments said, we want to create a generation of entrepreneurs, and because the public sector cannot take the influx of young people graduating, or young nationals graduating from schools, universities into the, simply cannot absorb. I think no country in the world can absorb most of the majority of the graduates of schools and universities. So in a drive to promote entrepreneurship, is basically, you see the government basically taking a stand and a position to fund these startups through VCs and other vehicles. So, and I think it's a good step, because some of the roles the private sector cannot take. For instance, healthcare, if you take something, there has to be basically a public sector solution for certain things: education, healthcare, developing a skill set of the youngsters to come and open up new companies and startup. So I think it's a good move, because if we leave it completely to the private sector, private sector works on profit and loss and feasibility, and unfortunately it will not pass. Actually, I found it very difficult to raise, especially during the past few months, pre-seed and funding, and we have brilliant ideas. I think one of the questions, there are a lot of great ideas there. But if there is anything happens in the market, the sentiment is kind of depressed or not feasible, it takes its toll on the good ideas and the bad ideas. I mean, nobody wants to invest in bad ideas, but even good ideas also get kind of squashed because of, the investors are not in a mood to invest. I think we want to basically see a better involvement of the private sector, be it family offices or VCs or whoever, is to basically help these startups from the start. And we always talk about the funnel, sales funnel. You cannot pick up the middle section of the funnel without looking at the top of the funnel. If you don't have a top of the funnel where basically you need pre-seed for these startups at the top of the funnel, you will not have anything coming down, trickling down. You'll have a very, as I said, I use the word trickling. It would be very small number of, you cannot build a economy based on a very small funnel that doesn't give you enough base of startups. And we're talking only fintechs today. But you need, there is a huge, gap in, if you take fintechs, I can probably, without looking into many of stats, 60% or 70% of fintechs are in the payment industry. What about the rest of, areas of basically banking and finance to be disrupted?
So speaking of the rest, sorry to cut you off, but now you're talking about something I'm very passionate about. This year in the UAE, we have COP28, and last year we had it in Egypt. We had COP in Egypt. So we're seeing an increasing focus in the region on impact. Financial technologies is not necessarily seen as contributing towards impact. But with these kinds of conversations happening in the region, and you're seeing, traditionally tech conferences now talking about impact as well. STEP next week in the UAE, we've seen a few conferences in Saudi as well, talking about impact. More and more, this conversation is happening. Financial technologies does have a role to play around supporting communities that are most affected. And Noel, with Now Money, this maybe through, let's say, sometimes maybe not seem as such a direct way that it supports impact, but it really does in terms of supporting those who are affected by climate. What is the opportunity for impact-driven founders in this region, given that historically, the funnel that Mohamed is talking about, they didn't necessarily have those opportunities for funding?
Yeah, it's an interesting one. I think Mohamed made a couple of great points. Like there's, if you look at the funding landscape here, what you would call seed or pre-seed here versus Europe or America is entirely different. There's a lot more due diligence done in terms of ideation. And to Mohamed's point, if you've got everybody who's doing a different version of a payment app, there's not enough differentiation for that to warrant. So those people in those seed and pre-seed should be absolutely bootstrapping to get some traction, to move themselves down the funnel to those people who want to invest in the growth part, as opposed to just needing capital because you've got a good idea. But if we go back to the impact, we very much see that Now Money, the value add, if we're going to make a significant change in financial inclusion, then corporate social responsibility and ESG are two tenets that we need. And if you say to me, why are things not moving as quick as they should? Well, regulations, government, compliance, and technology providers is what's required together for it to work. So there's never, in the last 10 years, there's been more people into the banking world than there has in the previous 100, even though we've had some of the worst years of the last decades. So we are making great changes. There is a lot of initiatives out there in terms of inequality, changes from gender inequality to financial inequality. And although COP28 is very much climate change driven, it does have a large part of it to do with financial, sort of changing the gap in the market and the insecurities and where people are being left out, because whether it's climate or not, these people still need people to have access to capital. So we very much believe that we are not a financial technology company that is operating products or services. We are a social impact, financial inclusion technology company that's trying to make change. And those funds and VCs that start to move towards ESG will be more interested in that. But also, when it comes to governments, initiatives and regulators, the more that they come on board, the better valuation of your company, but also the valuation of you as attraction and making a change. So I think it's very important that not to just associate yourself with social impact just because it's cool. But if there is things and ideas that people have that could make change in that environment, there's going to be a lot of money around for it. Each one of the big GCC countries has between 3 and 10 billion put aside for ESG. All the big sovereign wealth funds all have ESG related targets. And right now, outside of climate, they don't have a lot of other elements that they can operate in. And improving financial inequality and banking is certainly one area where that can happen. But that isn't in traditional payments and fintech as we would associate it here. That other 40% that Mohamed talks about, there is a lot of other gaps in the ecosystem that are there to be filled. And I feel that there's going to be money available for that. There's going to be less money available for those ideas which look very similar, because other companies will end up waiting for each other to run out of money and buy each other. That's what's most likely to happen.
Yeah, I just wanted to add, sorry, Mohamed, I just wanted to basically, since nobody is defending the regulators here, I'll just take that role for a minute. The regulators basically are working on the go. And we don't blame them. As Noel said, banking has been, the rules, the regulation, at least you're talking about 100 and 150, if you take the learning from other developed nations. And normally we learn. And by the way, central banks talk to each other. So it's not a secret. So because they want to make sure that, every country is basically well versed in the industry. But just remember, 3 years ago, Jan or Feb 2020, nobody was talking about something called COVID-19. And the healthcare sector, the pharmaceutical companies, the governments, you name it, we had to learn on the go, on the fly. And this is what's happening. Probably it's slower. However, this is what's happening, is that a lot of these new things happened only. I'll just give you an example. I was reading that knowledge gets doubled every, guess how many, give me a number, every how many years, days, hours? What do you think?
I'll put it in the seconds.
It's every 12 hours. This is the last thing I read last week. Maybe in seconds this week, I don't know. Imagine in 1945, it used to double every 25 years. So if 1945, you have to wait until what, 1960 to basically double your knowledge.
And I think everyone here doubled their knowledge today. We only have 1 minute left. So in our last panel, we had a huge debate between the panelists and the audience on growth versus governance, and a lot of the audience couldn't seem to see that these two things can go hand in hand. So just 30 seconds each before we close off. What are your thoughts? Growth or governance, or both?
From my side, it'd be growth with governance, not one without the other. You always got to be growing your business, but you're growing your knowledge in the governance. You can't wait for the growth at a certain point before you enter governance, and you can't over-govern yourself. So I think a healthy part of growth with an eye to governance, but also the governance is relevant for the size of your operation, what you're trying to fulfill, and as Mohamed said, the changing regulations that are happening. So it doesn't mean that you got 50% of your strategy is governance, but growth with an eye on governance is my view.
For me, look, I'm a little bit biased because I'm pro innovation, and I quite write a lot in innovation. For me, progress comes from making mistakes. The more mistakes you do, the more you learn. So, and there is a price for every mistake, don't get me wrong, but this is the cost of learning. You move forward by making mistakes, not by not making anything. You are more at risk if you don't take any risk. So I think, you know, in the banking industry, you know, if you basically book loans, and you know that some of the loans you booked will default, some of the, you know, so you should be comfortable with the default in order for you to move forward. It's part of the game.
Calculated risk. Really sorry we couldn't get to all of the questions. We tried to cover as many of those topics as we could. Huge thank you to Noel and Mohamed for being with us today. We all doubled our knowledge in 1 hour. And thank you as well to our partners ICD and to Vinita and to Aya for supporting on the webinar, and everyone else who was involved. And with that, we'll close our session for today. Thank you both very much.
Thank you.
Thank you so much.
Thank you.
Bye.
Thank you, Mohamed. Thank you, Noel.